Hello and welcome to this podcast. This podcast is part of a series in which we examine the definition of gross income. So far we've looked at what it means to be a resident in South Africa for tax purposes and what it means to have income from a South African source. In this podcast we're having a look at amount in cash or otherwise. This part of the definition is important because if you don't have an amount that can be established, then you do not have gross income. One of the earlier cases in gross income debates was around whether an amount must be cash or not in order for there to be an amount. And in CIR versus Lategan, the court said we're trying to have as wide a definition as possible. So every form of property which has a money value is potentially an amount for the purposes of gross income. We then found that it must be an amount that's expressible in money in order for there to be an amount. In CIR versus Butcher Brothers were lessors of property, and as part of the rental agreement, they were entitled to improvements by the lessee. The lessee made those improvements, and SARS tried to include that in gross income, and the court said that it was not possible to put an amount to what Butcher Brothers had received. They hadn't received the improvements because they weren't entitled to use them until the conclusion of the lease, and no plausible way had been put forward of how to put a value to what they had received. Now, looking forward, we know that there is a special inclusion to deal with leasehold improvements, but the reason that's there is because the general definition doesn't bring it in because we can't put an amount to it. In Commissioner for SARS versus Brumeria Renaissance developed old age homes, retirement complexes. And instead of selling the units to people who wanted to retire there, they allowed the tenants to live in the units rent-free. They gave them a life right to live there for as long as they wanted to, rent-free. And in return, the tenants had to provide Brumeria Renaissance with an interest-free loan. Brumeria then argued that that wasn't gross income because a loan does not represent gross income and that they hadn't received anything in cash or otherwise. The court found that they had received something. What they had received was the right to an interest-free loan, and it was possible to express the value of that right in money. And the value of that right was the interest that they would have had to pay if they had borrowed that money from a third party instead of from their tenants. In return, Brumeria had obviously also provided rent-free accommodation to the tenants, and that also had a value. There was then a question about whether all interest-free loans would then give rise to gross income, and SARS, after a while, came out with its interpretation where they said that they would only pursue interest-free loans where the recipient of the loan was providing something in return for that right. Now, when we're trying to put an amount in money to what is being received or accrued, we must look at what the true intention of the parties is. That comes from the case of Leys Proprietary Mines. In that case, Leys Proprietary Mines were selling a mine, and in return they were receiving shares in the company that was the buyer. And the way they'd structured the contract was that the price that they put on the mine was the par value of the shares multiplied by the number of shares that they were entitled to receive. That created an artificially low value because in actual fact what they were transacting on was obviously not the par value of the shares but the market value of the shares. Market value was considerably more, so actually what they were receiving was a lot more than par value. The court said the intention of the parties is not to contract at the value in the contract. The intention is to receive shares, and those shares are at their market value. So Leys Proprietary Mines had to include a much larger amount in gross income than was the value that was nominally put in the contract. And finally, total amount in cash or otherwise excludes notional amounts. So you cannot have something included in your gross income based on what you should have earned or could have earned. What you've actually received or accrued is what is included in your gross income. So if you choose not to put your money in the bank, you can't be taxed on the interest that you could have earned if you had put the money in the bank. You also can't be taxed on the higher price if you could have sold what you sold for more than you in fact did. It's about the actual amount, not notional amounts. In the next podcast, we're going to have a look at what received or accrued means. So I hope you'll join us for that one.